Hi everyone, welcome to Lecture 6 on Accounting for Non-Controlling Interests. It's the last consolidation accounting lecture, and usually you do get a question in your final exam with consolidation accounting with non-controlling interests. So this lecture is quite important. So the objectives are as follows. So first, to understand the nature of non-controlling interests. Next, to identify why and how we calculate non-controlling interests. We're also going to look at the calculation of goodwill in the presence of non-controlling interests. And finally, we're going to prepare consolidated statements that include disclosures of non-controlling interests and the parent entity interests. The contents are as follows. First, you're going to learn what non-controlling interests means, the disclosure requirements in relation to non-controlling interests, how to calculate non-controlling interests, how non-controlling interests impacts on the calculation of goodwill, and the effect of non-controlling interests on goodwill impairment. And finally, we're going to have a look at non-controlling interests calculations in the presence of inter-entity transactions or intra-group transactions. In all the examples we've looked at so far, so up until topic 5, the parent controlled 100% of the shares in the subsidiary. However, in the examples we're going to look at today, the parent will control the subsidiary, but with less than 100% ownership. For example, it is possible to control another entity with, let's say, 75% ownership. So what happens with the remaining 25%? The remaining 25% is what we call non-controlling interests. It's defined by AASB 10 as follows. The equity in a subsidiary not attributable directly or indirectly to a parent entity. So the ownership in the subsidiary that is not owned by the parent. Okay? Note we're looking at equity here, and this is going to be where the focus of all the calculation is going to be this week. We're simply going to have a look at the equity of the subsidiary and allocate a portion of this equity to the non-controlling interests. Often, most subsidiaries are wholly owned in the example of Wesfarmers, where most of its subsidiaries are 100% owned. And that's the reason why Wesfarmers does not disclose non-controlling interests in its annual report. Not because it's not complying with AASB 10, but because the amount for the non-controlling interests is so small that it's not material for Wesfarmers to show the non-controlling interests in its financial statements. However, we still need to know the consolidation techniques and how these techniques change when there is non-controlling interest, because many other groups do disclose non-controlling interests. So here we have a very important, what I think is a very important diagram. Okay, this helps with your understanding of what you're trying to do. So if you recall, when we're doing the accounting, we're always doing the accounting from the group's perspective. But what's usually given to us is what's for the parent. So the accounting of the parent, prepared by the parent from the parent's perspective. We're also given the accounts of the subsidiary that we put together next to the parent in the worksheet. Next. In this example, the parent controls only 75% of the shares in the subsidiary, and the remaining 25% is owned by the non-controlling interests. So how is this non-controlling interest viewed from the group's perspective? Well, from the group's perspective, the non-controlling interest owns shares in the group. So from the group's perspective, the non-controlling interest is an equity account. Okay, they are the shareholders in the group. So how is that going to impact on our accounting? So note, we're still consolidating parent and subsidiary because we're consolidating what's there within the group. Okay? Note that when we consolidate, it means everything in there, in this little black box here in the parent, and everything in this little black box here in the subsidiary, will merge together. They'll be aggregated. On top of that, what we're going to do, so let me use blue for the parent. On top of that, we're going to separate the equity of the parent from the equity attributable to the non-controlling interest. So in this example here, the parent has 75% of the equity in the subsidiary. How about the non-controlling interest? Well, what the group needs to show is that, hey, this remaining 25% here in equity is for the non-controlling interest. So that's equity of the group attributable to the non-controlling interest. Okay, I think that this picture comes in handy when you're trying to figure out which adjustments to do or why a particular calculation or entry is being done. Okay, so let's continue with a bit more details provided on the slide here on the calculation. So where a subsidiary is partly owned by a parent entity, both the parent and the non-controlling interest will have an ownership interest in the subsidiary's equity. This equity, for example, can be profits, dividends payment, share capital, and reserves. So there's a little list here of 4 equity accounts. And of course, there might be more accounts like retained earnings, fair value adjustments, revaluation surplus, etc. As part of the consolidation process, we need to work out the amount attributed to the non-controlling interest. Specifically, if I go on the previous slide, we're trying to work out what's in the purple area. And it's not very hard, especially you'll see in the first few examples. It's pretty straightforward, where you're simply taking, so for in this example, you'll take 25%, multiply by each of the equity account that you find in the subsidiary's trial balance at the end of the financial year. The disclosure requirement for non-controlling interests. Non-controlling interests are required to be presented in the consolidated statement of financial position within equity separately from the equity of the owners of the parent. What does that mean? It means that if from now on, if you have a look at the statement of financial position, you will have a list of assets, liabilities, and then under owner's equity, what you will find is you'll find retained earnings, share capital, a number of reserve accounts, and what you'll find here is non-controlling interest. Calculated as, or if I have a look at the previous diagram, you simply take 25% times all the equity in the subsidiary. Okay? Next, paragraph B94 and B95 requires that the entity attribute the profit or loss of each component of comprehensive income to the owners of the parent and to the non-controlling interest. So if I am to erase this little section here, in the statement of comprehensive income, what you'll see is, well, what we've done up until now is in the comprehensive income, we have stopped at this account called profit after tax. Okay, you can just add the tax. I don't have space here. Let me see. What you're required to do, so let's say the profit after tax is, let's make it $100. So what you're required to do is to split this profit. So show how much of the profit goes to the NCI. So this account is called NCI share of profit. So for short, I simply call it NCI. So let's say the subsidiary's profit was $10 and the NCI gets 25% of that. The NCI gets $2.50 of the profit in the subsidiary. The remaining is what goes to the parent. So that's profit attributable to the parent. So in this example, it would be $97.50. Okay, that's all we're doing. We're still getting to the point where we're calculating consolidated profit, which means we still have to do all the consolidation entries we've done already. We still have to complete our worksheet, and it's only after we've completed the worksheet that we can do this allocation. I'm still getting used to using this thing. So paragraph 12 of ASB 12 requires disclosure of the profit or loss allocated to the NCI and the accumulated NCI at the end of each reporting period. This disclosure requirement, as stipulated on the previous slide by AASB 10, is also consistent with AASB 101, presentation of financial statements. AASB 101 also requires the disclosure of the parent's interests separate from the non-controlling interests equity. So what are we going to do? Well, our objective is to calculate the non-controlling interest proportionate share in all the equity of the subsidiary, such as issued capital, reserves, opening retained earnings, profit for the year. Of course, here what you're using is profit after tax, not before tax. Dividend distribution for the period, so that could be dividends paid or dividends declared, and transferred to and from reserves for the period. Note all of these accounts here. So if we have issued capital, that would increase your non-controlling interest. Any reserve will increase your non-controlling interest. So retained earnings will increase, profit will increase, but when you get to dividend, it's going to decrease your non-controlling interest. Okay? Because dividends are distributed out of retained earnings. So it decreases retained earnings. When you get to transfers to and from retained earnings, no change. Okay? Because it might be that retained earnings is increasing, but another equity account is decreasing, so there's no impact on equity. How do we calculate non-controlling interests? The non-controlling interests are identified for disclosure purposes. Disclosure purposes only, and they're not eliminated as part of the consolidation process. The entry that we record for non-controlling interests is actually very similar to the elimination entry, but we're not eliminating non-controlling interests. All we're trying to do is allocate the equity of the subsidiary attributable to the non-controlling interests. There'll be two consolidation entries that you will have to adjust when we have non-controlling interests. The first one is the elimination entry. So now the parent does not own 100% of the shares in the subsidiary, and the parent only acquires a proportion of the equity of the subsidiary. So here we're only going to, when we do our elimination entry, we're only going to eliminate, if let's say we continue with this example in our first diagram, we'll only eliminate 75% of pre-acquisition equity. Okay, so that's the first consolidation adjustment that will need to be adjusted for the percentage share ownership of the parent. The second one that will change is when we're dealing with dividends. Whether the dividend is paid or declared, you will only eliminate 75% or whatever percentage is owned by the parent. Okay? And that's because only the dividend paid to the parent is an intra-group transaction. Dividend that is paid outside the group to the non-controlling interests is not considered an intra-group transaction. Okay, so only 2 consolidation entries will need to be adjusted. Everything we've learned so far will stay exactly the same. Non-controlling interest and goodwill. The accounting standard gives you a choice as to how you measure your non-controlling interests. First, you can either measure your non-controlling interests at fair value, or at the non-controlling interest proportionate share of the acquiree's identifiable net assets. If you're using fair value, then the amount will be given to you in any question, so you don't have to calculate anything. If it's not given to you and the question says the proportionate method is being used, then you will have to calculate the amount of non-controlling interest. Note that the calculation is not very hard. All you're going to do is identify the percentage ownership of the non-controlling interest. So let's say it's 25%. You take 25% and you multiply that by each equity account of the subsidiary, and that would be it. So while it seems here that, hey, one you have to calculate, and the first one, the fair value, you don't have to calculate, then you would go for fair value. Actually, no. The fair value is actually the harder one to do. And we're going to have a look at an example of both methods soon. So what's the difference between the two methods? If the non-controlling interests are calculated on the basis of fair value of the subsidiary, then an amount representing the NCI share of goodwill will be calculated. Okay, so that's the first difference. Under the fair value method, you have to calculate goodwill. This would be in addition to the goodwill already allocated to the parent. This approach is called the full goodwill method. Let's compare this with the proportionate method. Under the proportionate method, no additional goodwill will be calculated as being attributable to the non-controlling interests. This approach represents the approach that was required prior to recent amendments to the accounting standards. This is often referred to as partial or proportionate interest goodwill method. So what's the main difference between the two? Well, under the fair value method, the fair value is given. Under the proportionate method, you actually have to calculate the non-controlling interest. The second difference is, under the fair value method, you have to calculate goodwill for the non-controlling interest, whereas under the proportionate method, you do not have to calculate goodwill attributable to the non-controlling interest. Let's have a look at 2 examples, and these examples come from your textbook. So either you can get your textbook ready now and have a look at the information, or the most important information is provided on the slides in this lecture. Okay? So this is not properly formatted, but there's nothing I can do here because it's in the PDF version. So what I'm going to do is try to highlight them to be able to read through this little table here. So what we're doing first, I'm just going to use a little black pen here, is simply take at the date of acquisition, which is 1st of July 2000, Yarra Park acquired 75% of the shares in Corio. So we know Yarra is the parent, Corio is the subsidiary. Why is it important to identify clearly who's the parent and who's the subsidiary? Well, that's because we have non-controlling interests in our question, and the non-controlling interests have a share in the equity of the subsidiary only. Note 75% of the shares is owned by the parent, which means the non-controlling interest owns the remaining 25%. So what we're doing at the date of acquisition is we're simply taking the equity of the subsidiary. So identify pre-acquisition equity of the subsidiary. Note this is no different to what we've been doing already. So you identify share capital, retained earnings at 1.6 million, and fair value adjustment, which you have to calculate. Okay? Calculation stays the same. Calculation as usual. So you take fair value, you minus carrying amount, And don't forget to remove the tax. That is, don't forget to multiply by 70%. Okay? So here you get a fair value adjustment of $700,000 after you've done this calculation. So if you have a look at the question, it tells you that the difference between fair value and carrying amount is $1 million, multiplied by 70%, $700,000. So that's all we do. Next, we're going to do the acquisition analysis for the parent. So noting that the parent only acquires 75%. Okay, so I'm going to use a different color for the parent. Let's say I'll use green for the parent. So the share capital, what we're doing for the parent is the parent owns 75%. For share capital, take 75% of 3.5 million is equal to 75% of 1.6 million is equal to, and 75% of fair value adjustment is equal to $525,000. So here you get a total equity acquired at $4,350,000. The purchase price is given to you in the question as $5 million. Note, we don't have to apportion the $5 million. We had to make the apportionment to the pre-acquisition equity because the parent only has 75% of equity. Whereas the purchase price is simply as given in the question. That's $5 million paid for 75% of the equity. Okay, so here we have a goodwill of $650,000. Note, what's new for this week is we need to calculate the amount for the non-controlling interest. And the calculation is not very hard. So it's 25% multiplied by the equity of the subsidiary. So you take 25% multiplied by 3.5 million, you get 875,000. 25% multiplied by 1.6 million, 400,000, and 25% multiplied by 700,000, 175,000. So what you've just calculated here, if you just add these three numbers, is the NCI. That's it. So this is as simple. All we've done using the proportionate method is calculate the value of the NCI. Okay, note that the NCI is an equity account, so if you want to recognize it, you will use a credit. Okay, so you're given additional information here. You're told that Corio leases facilities from Yara for $120,000 per annum. Corio's interest revenue from Yara is $65,000, and Corio's land is carried at $1 million below fair value, and that there is no impairment of goodwill to date. The dividend is $345,000. Okay, that's dividend paid to the parent only. If you have a look at your textbook, you will see that full dividend declared is $460,000 by the subsidiary. The tax rate is 30%. So this is the consolidation adjustment entries required. So what we're going to do first is we're going to revalue the land. Note, you don't have to revalue the land first every time. Okay? The order of the consolidation adjusting entries is up to you. But my advice to you is to always stick to the same order so you don't forget consolidation entries. So I'm simply going to follow the order provided on these slides. So first I'm going to revalue the land. So you were told that it was $1 million below fair value. So I'm going to increase the land. So I'm going to bring it up, increase it, debit $1 million. Next, I transfer 70% of the increase to fair value adjustment, which is an equity account. That's why it's a credit. And I transfer the remaining 30% to the DTL account. Okay, so note we have a DTL here because we have increased an asset. Every time you increase an asset, you have to do a balance sheet tax effect. You might end up with a DTL or a DTA. So here we have a DTL because we've increased an asset. An increase in an asset means that you expect more, that the group expects more future economic benefits from the asset. So what you're doing here is you're increasing future tax to be paid on these future revenues. So more future revenues, more future taxes. Next, what we're doing is the elimination entry. So we're going to debit all pre-acquisition equity. So you can have a look at the acquisition analysis to do the entry. Note something has changed here. You can only eliminate 75% of pre-acquisition equity. Okay, so that's something different to what we did in topic 5. So we're only going to multiply pre-acquisition equity of the subsidiary by 75%. Okay, so I'm simply going to highlight the change here. With the goodwill, no, don't get too excited and multiply everything. The goodwill you don't have to multiply. The goodwill is simply as calculated from the acquisition analysis. Okay, so that's as calculated from acquisition analysis. The investment account is as given. You don't have to multiply this one by 75%. It's simply telling you how much the parent paid for 75% of the equity in the subsidiary. When it gets to dividends revenue and dividends paid, you also have to multiply by 75%. Okay? Why? Well, if you have a look at the original diagram that I showed you before, only the dividend paid to the parent is an intra-group transaction. This is the only thing that's within the circle. The remaining 25% goes to the non-controlling interest. Okay? So to eliminate dividend, we do debit dividends revenue, credit dividend paid, and you would have seen this entry many times already. But you have to make sure here that we multiply our dividend. So if you have a look at the dividend in the question, you'll see that it's $460,000. So I put a K because I don't have space here. Okay, so all you're doing is multiply the dividend paid by the subsidiary by 75%. So $345,000. Next, we're going to do consolidation entries to get rid of intra-group transactions. So we're going to, the first information provided in the question is that Corio provides a lease to Yara. So what's happened is an operating lease. So Corio would recognize a lease revenue using a credit. What we're doing here, all we're trying to do is eliminate these entries in full because they're intra-group transactions, and from the group's perspective, they did not happen. Okay? So what we're doing here is we're decreasing the lease revenue recorded by Corio. So we're trying to get rid of it. Yara would recognize a lease expense. It's called other expenses here. All you're doing to eliminate an expense is use a credit. Okay? The other side of the equation is cash, but cash is never a consolidation entry. That's because Corio receives cash and Yara pays cash, so the net effect is zero. $120,000, no adjustment. Note you've already looked at a similar entry last week. Next, interest revenue. So you were told that Corio receives interest revenue from Yara. So Corio receives interest revenue. It does credit interest revenue. What we're doing here is a debit to decrease it, to eliminate it. Yara is paying interest expense, so debit interest expense. What we're doing here is credit the interest expense to eliminate it. Okay, $65,000, no adjustment. Next, it's not on the slide. I think it got omitted by accident, but it's in the textbook. You're also told that Corio provides a loan to Yara. So in Corio's book, Corio will have credit cash, it provides a loan, and debit receivable from Yara. What we're doing here is eliminate this receivable recorded by Corio. Okay? Yara receives the cash, so Yara records debit cash, credit payable. What we're doing here is debit the payable to eliminate the payable. Okay? $670,000, no adjustment to the numbers. This is where we're finding the new entries. Okay? So note so far what's new from last week is we had to adjust the dividend adjustment, multiply by 75%, and adjust the pre-acquisition equity in the elimination entry, multiply by 75%. we have to do additional entries as well. So what we have to do now is record the amount for non-controlling interest. Note that a non-controlling interest is an equity account, so we're going to credit non-controlling interest if we want to increase non-controlling interest. So what we're doing now is we're going to allocate 25% of pre-acquisition equity to the non-controlling interest. Okay, so what we're doing is we're decreasing this pre-acquisition equity and we're transferring them to the non-controlling interest using a credit. Okay, so 25% of each of these equity accounts has now been included in the non-controlling interest. Next, so I'll have to draw a timeline for you. We're doing the entries note in 2002. The date of acquisition, so if I draw a quick timeline here, is in the year 2000. Then we have 2001 and we have 2002. So what we're trying to calculate in this next entry is that we've already attributed retained earnings at the date of acquisition to the non-controlling interest. Okay, where did we do that? Oops. We did it in the entry right here. Right here. Okay, but what's going to happen is retained earnings is going to increase or decrease over time depending on whether there's profit or losses. So what we're doing next is simply identify any increase or decrease in retained earnings in the previous year. Note, we don't have to do it in the current year because in the current year we're simply going to use profit and dividend. This is what we're going to do in the next slide. Okay, so what you'll have to do now is we already know the retained earnings at the date of acquisition. It's 1.6 million. We saw that in the acquisition analysis. But you need to know now the retained earnings at the beginning of the financial year. Have a look at your textbook, and what you'll see there is that the opening retained earnings is $2,120,000. That's retained earnings at 30th of June 2001. We're trying to get the retained earnings right here. Okay? So take the difference between these two figures, multiply it by 25%, and you get 130. Because the retained earnings has increased, we're going to increase the non-controlling interest using a credit. Next we're going to do current year. So if I go back on the previous slide, so now we're going to focus on this current year. Now you're going to identify current year profit, making sure it's after-tax profit. So have a look at your book in the worksheet, and if you have a look at profit after tax, you'll see that profit after tax is $870,000. Okay, so all you're doing here for your calculation is you take $870,000 and you multiply by 25%. That's all. So debit share of profit and credit the NCI because we are increasing the NCI. Okay, so the share of profit account, we are also increasing it, okay, using a debit to share of profit because that's how you create this account. I will spend a bit more time in the seminar next week focusing on the NCI share of profit when we have a look at the homework question. But for now, note that a debit increases this account. From a group's perspective, this account is like a dividends paid or a dividends declared account. Okay. Next, we're going to look at the current year's dividend. If you have a look at your worksheet, you'll see that the current year's dividend is recorded at $460,000. We're going to do this entry for the NCI, multiply by 25%. Okay, so here we're going to debit the NCI. Why? Because NCI is getting a share of equity, but dividends decreases equity, so we have to decrease the NCI, and then we credit the dividends paid. Okay, so 460 multiplied by 25%. This is what we call a memorandum. So we're going to put here everything we've done. Okay, so we started with opening retained earnings of 1.6 million. There was an increase of $520,000 in the previous year, and the retained earnings at the end of the financial year is $2,120,000. The NCI gets 25%, so here it is, 530. Profit for the year, I've already asked you to identify that, $870,000. NCI gets 25%, $217,500. Dividends paid will decrease the NCI because it's an equity account and dividends decrease equity. 460, NCI gets 115. Next, you will find other equity account in the worksheet at the end of the financial year. Issued capital is at 3.5 million. NCI gets 25%. And fair value adjustment note, the fair value adjustment is $700,000. We calculated that as part of our acquisition analysis. Put a little note for yourself here, not to forget. I've seen that often students forget about it. Do not forget. Why do students forget about it? Well, to get all the information here. Well, this is given in the subsidiaries book, this is given in the subsidiaries book, this is given in the subsidiaries book, and this is given in the subsidiaries book. Fair value adjustment is not given in the subsidiaries book because that's an equity account created from the group's perspective. From the group's perspective, the subsidiary should have it, but it's not there in the subsidiaries account. And because we're doing the accounting from the group's perspective, we should put the fair value adjustment when we're calculating the NCI. Okay? So the total NCI is that much. So that's how much you would disclose in your statement of financial position for the value of NCI. Okay? So this is the end of the first half. I'm going to do the second half.